Good morning. I warmly welcome you to the financial accounting class. Students, in this class we are discussing about the adjustments in the final accounts. First adjustment is closing stock. Closing stock means the unsold goods lying in store at the end of the accounting year. The treatment of accounting is stock account debtor to trading account. There is twofold effect on adjustment. First one is show on credit side of the trading account by closing stock, on asset side of the balance sheet. Okay. Then second adjustment is outstanding expenses. Outstanding expenses means those expenses which have been incurred and not yet paid. The treatment of account is expenses account debtor to outstanding expenses. In this outstanding expenses has twofold effect. First one will be shown on the debit side of trading profit and loss account by the way of addition to particular expenses. Okay. The second one is effect will be shown on the liability side of the balance sheet. Outstanding expenses. It's a current liability. Then prepaid expenses. Prepaid expenses means those expenses which have been paid in advance, that is, whose benefit will be available in future, is called prepaid expenses. The treatment of account is the prepaid expenses account debtor to expenses account. In this also twofold effect. First one will be shown in the profit and loss account by the way of reduction from the particular expense. Another will be shown on the asset side of the balance sheet. The next one will be the accrued income. Accrued income means that income which has been earned but not received during the accounting year is called accrued income. The accounting treatment is accrued income account debtor to income account. There also a twofold effect will be shown on the credit side of profit and loss account, and another one will be shown on the asset side of the balance sheet. Next adjustment is unearned income. Unearned income means income earned but not earned during the accounting year is called income received in advance. Accounting treatment is income account debtor to income received in advance. The first fold effect will be shown on the credit side of the profit and loss account by the way of deduction from the particular income. The second one will be shown on the liability side of the balance sheet. Then next adjustment is depreciation. Depreciation is the reduction in the value of fixed asset due to its use, wear and tear. The accounting treatment is depreciation account debtor to asset account. This adjustment has twofold effect. First one is shown on the debit side of the profit and loss account. The second one is shown on the asset side of the balance sheet by the way of reduction from the concerned asset. The next item is bad debts. Bad debts means debts which are definitely irrecoverable are called bad debts. The accounting treatment is bad debts account debtor to sundry debtors account. This adjustment has twofold effect. First one is shown on the debit side of profit and loss account. Second one is shown on the asset side of the balance sheet. Next one is interest on capital. To see whether the business is really earning profit or not, interest on capital at a certain rate is provided. The accounting treatment is interest on capital account debtor to capital account. In this adjustment has also twofold effect. First one will be shown on the debit side of the profit and loss account. Then second one shown on the liability side of the balance sheet by the way of addition to the capital. Then interest on drawings. Interest on drawings is charged from proprietor as drawings reduce capital. The accounting treatment is drawings account debtor to interest on drawings. Then this also have twofold effect. It will be shown on the credit side of the profit and loss account, another one on liability side of balance sheet by the way of addition to the drawings, which are ultimately deducted from the capital. Next adjustment is provision for doubtful debts. It's a provision created to cover any possible loss on account of bad debts likely to occur in future. Accounting treatment is profit and loss account debtor to provision for doubtful debts. This also have twofold effect. One is on the debit side of profit and loss account way of addition to bad debts. The other one is shown on the asset side of the balance sheet by the way of deduction from the sundry debtors. Next one is loss of stock by fire. Loss of stock may occur due to fire. The position of business may be all the stock is fully insured, the stock is partly insured, the stock is not insured at loss. First case, if the stock is fully insured, the whole loss will be claimed from the insurance company. The accounting treatment is insurance company account debtor to trading account. The effect it will be shown on the credit side of trading account, and another one is shown on the asset side of the balance sheet. Second case, if the stock is partly insured, the loss of stock covered by the insurance policy will be claimed from the insurance company, and the rest of the amount will be loss for the business. Entry is insurance company account debtor, profit and loss account debtor to trading account. In this also have two effects. First one is shown on the credit side of the trading and profit and loss account with the value of stock shown on the debit side of the profit and loss account for the part of the stock which is not insured. Second one is the loss of stock fire is shown on asset side of the balance sheet, which amount is to be realized from the insurance company. Next one is if the stock is not insured, whole loss will be borne by the firm. Entry is profit and loss account debtor to trading account. The effect of this entry first is shown on the credit side of the trading account. Next one is shown on the debit side of the profit and loss account. The next one is reserve fund. Reserve is created out of profit and loss account and thus is an appropriation of net profit for strengthening the financial position of the business. The accounting treatment is profit and loss account debtor to reserve fund. There is also twofold effect will be shown on the debit side of the profit and loss account, another will be shown on the liability side of balance sheet. Then the last one is manager's commission. Manager's commission means is to increase the profit. Manager is given some percentage of commission on profit. It can be given at a certain percentage on the net profits, but before charging such commission. The accounting treatment is profit and loss account debtor to commission payable. After charging such commission calculated by the formula commission payable is equal to percentage of commission divided by 100 plus rate of commission into residual profit. Okay, thank you students.